Yeah, look, are you there?
Yes, I can hear you.
Okay, good evening.
Good evening.
So, apologies for the delay. I don't know what happened because it's the normal way I send the invites. So I wonder why it was requesting for email address and password. All right, it's
Problem.
fine. Yeah. Okay, so the other videos say you have not watched them, you not
Yes.
listen to the other lectures. Okay, it's fine. It's not going to affect this one that we're going to do today. Because what we just look at today is sensitivity and scenario analysis.
Okay. Hey, now begin to cry like this.
Honestly, oh, don't mind the boy, Jerry. All right. Okay, um, so what I'm going to do is let me just quickly share the screen. So we just quickly look at it. But I would advise that you watch that video because
I will
there's some
definitely.
yes, there's something you will do to this financial statement. You understand? You
Okay.
attend you attend add-on business valuation.
Okay.
Do you get? Yeah, business valuation is part of the video I sent. If it's not there, let me know. So it's going to be like a
Okay.
task that you will do. Do you understand? So we are going to build
Okay.
on that the integrated financial statement. You get now.
Okay.
So let me share my screen. All right, can you see my screen?
I can.
Okay. Um, um, let me see. Yes. So if you can remember, I know this is a
Okay.
file we worked on, right? This is the file we worked on the last time now.
Yes.
And this is the one I gave to you
Yes.
in the video. If you can remember, something like this. Then I said, what I now say you should do, which is like your kind of assessment, like assessment that at least you understood that integrated financial statement, is that what you use this trial
Yes.
balance. Use this trial balance, are you getting me? To build this. Use that trial balance to
Yeah.
build this financial statement here, the historical financial statement, everything. You can do that now. Use it to build this one. It's similar to what we have done before. You understand? So the only thing now is that this one now has supporting schedules. So this one has supporting schedules. When you watch that video, you will see how we built all these ones. So what you will now do is you will compare. Are you listening to me? From that
Okay.
video now,
Yeah.
you will compare the method we use here and the method we use in this one. Do you get?
Okay.
So compare the method we use here. You know we did this one together, Abi.
Yes.
So compare the method that was used here, the one that has supporting schedule. Compare how we did this to how we did this. Obviously, this one doesn't have supporting schedule. You understand now? So see what
Okay.
the difference is. You understand what I'm trying to say? So I just get used to
Oh,
the two scenarios, to the two methods. You understand? So that's
you
the
said?
assignment. I said what you will do is watch that video. In that video, you will see
Yeah.
you will see how we built this one.
Approaches.
Exactly,
Okay.
you will see this approach that has supporting schedule. And if you look at the way we did the forecast here, this is the forecast. If you look at the way we did the forecast here, based on that video, you will see that,
Okay. This
of
is the
course,
same one that was built in it.
yeah, this is the same one that was built in it. I sent you the file.
Okay.
So what I'm asking you to do now
Okay.
is, for you to know this, start with trial balance and
Okay.
build the historical,
Yeah.
integrate it, link it. You understand? Then after that,
I get.
you have all the assumptions here. Use these assumptions to do your forecast. Are you getting me? But
Yes,
this time when you are
definitely.
doing your
Yes.
forecast, you take note of, you see something like this. You see where you have your what's it called now? This account receivable.
Yes.
Okay, account receivable. There is a formula. There's a way we projected this one. You will see that in the video. You can see it's related to account receivable days. Revenue. You see what I'm saying? So there are specific relationships. So use that one to do the projection. And when you are doing it, you take note of the difference between this one and the other method. Yes, this one that we just did straight up. This one that we just did straight up without any supporting schedule. You understand? So that's what I'm asking you to do. You get now. So what we do now is we want to look at scenario and sensitivity analysis. You understand? So you can see we started this whole thing from the trial balance. So it's from the start, from scratch. And we're able to build something like this. So what I will do now is there's something I want to do here that will make this thing look more professional. So what I will do is I will go and unfreeze the pane test. You get now? So what I'm going to do now is I will take all this one, right?
Yeah.
I'll take all this one. I'll come to where I have data and I'm going to group. You get?
Yeah.
So I can collapse it. So everything just goes like this. Sure, you understand? Now here,
okay. Hello, excuse me. Was it when after you went to the group and clicked that group, that was when this collapse, this plus
appeared? Yes, that was when it came up. Yes. I should do it again so you see.
Yes.
Okay, let me undo. So let me undo. Sorry. So what I just did was I highlighted everything. You get?
Yes.
That I went to data. Data is already selected here. And now click on group. You understand? This one. Then just click on group. That's all. Then the minus sign will show up here. When you click the minus sign, it collapses it. That's what I just did. Yeah. So here now, are you getting me? Here, I can just come here. There's something I want to do here now. And I'll give this maybe something like this color. You get now?
Mm-hmm.
Can you hear me?
I'm with you.
So you see what I've done there?
Yes.
It's not necessary the color has to really extend to this level. You can maybe just cut it somewhere here. You understand?
Yeah.
It doesn't really have to be that long. So this is your financial statement. So the only point I want to see my financial statement, so everything drops here. You get now? I have to increase this color before because I wanted it to cover the entire stuff. You get now? So it makes sense like this.
Yeah.
So I can, sorry. So it makes sense, right? So I can still, so you have something like this. So now the next one you're not going to do is, so what I mean by add-on is the sensitivity and scenario analysis and add-on. Like it's like a part of the financial model. You understand? So that's why I call it add-on. So what we are just going to do here is going to have another. It will not really be this long. I'm not too comfortable with having it so long like this. You understand? So let me just cut it. Whichever way. What's important is you have the. Okay, so it's fine. So what I'm going to do now
is that's why the ones I've seen online, they do the financial statement downwards.
Downwards, exactly.
Income statements, cash flow, sheet, and just downward like that.
Yeah. Exactly. You can see this one is like that now. It's downwards. So if I collapse, so if I collapse all this now, see if I collapse all this, I'm collapsing everything.
Yeah.
So it depends on how you want to. You can see now. Yeah, it depends on how you want to present. But I think this one is better.
Yes.
But whichever way it is. So that's why I have to just call this one the financial statement.
Okay.
Do you get? I'm not calling it balance sheet. I'm not calling it income statement. I have to call it financial statement. So at once, when you just open this, you see all your financial statement. You see the 3 statements. Do you get? Yeah. So let's just quickly move to the business of the day. So let me call this one. Okay, sensitivity and scenario analysis. Okay, but before then, I'll just quickly explain what sensitivity and scenario analysis is. So when you say sensitivity analysis, you have an idea of what it is, right? Sensitivity analysis. I say you have an idea of what sensitivity analysis is.
Yes.
Yeah, what do you know about it? Let me just hear your.
Well, I think it is used to ascertain the effect of a factor on other areas. Like I think the effect, like saying looking out for what the effect of an investment will be on the return on investment or something like that. I can't remember, but I think that's what I can pick out of it.
Yeah, you have an idea. Yeah, that's true. It's basically used to show the effect, just as you have said, the impact of maybe variable X. I can say variable X, a factor X on a variable Y, factor X on a variable Y. You understand? So that is what it is used for. So you want to see how Y will react when you change factor X.
Yes.
For instance, you want to see the impact on EBITDA when you change or when you vary a forecasting factor, for instance, sales forecasting factor. So you are changing sales forecasting factor from 5 to 7%.
Yeah.
And you want to see the impact it's going to have on EBITDA, on your EBT. So that is how sensitive is changes in those factor input on your output, on your model output. So that's what sensitivity analysis is saying. But scenario analysis is now saying that what will be the effects of some case, like how would I put that now? You have a situation, okay? So this situation can be a worst case situation or a best case situation. You understand? From a base case situation. So the current situation you have is a base case. Do you get? If the case gets worsened, is a worst case situation, and if it gets better, is a best case situation. So from a base case situation, you want to see if the business is worse off, given that a factor input or your forecasting factor. Now, when I say all these factor input I'm talking about, they are your forecasting factors. You understand now? So your forecasting factor has changed, okay, from, for instance, let me give you a good example now. A good example of scenario analysis can be this. You have a situation where sales, your sales projection, okay, is going to drop from 5% to 2%. Of course, that is a worst case scenario. You understand? That's a worst case scenario. But if there's an improvement of sales forecasting factor from 5 to 7%, that's the best case scenario. So you now want to see the impact of these scenarios on your performance metrics. So that is what scenario analysis is all about. So the difference between sensitivity and scenario analysis is just that sensitivity analysis looks at the effect of forecasting factor on your model output, while scenario analysis looks at situation. It's like more like a situation analysis. It looks at your best and worst, your best case, and worst case, and determine the impact on your performance metrics. So when I say the performance metrics, Performance metrics can be the EBITDA, the EBIT, the EBT, the profit after tax. Those are performance metrics. You understand now? So all these factors, your gross margin as well, they are performance metrics. You get now? Are you still there? Are you still with me? This guy has gone offline. I'm talking to myself. Hello? Yeah, can you hear me? Are you there?
Yeah, hello. I am back. Oh, I don't know. The network just tripped off here.
The network. I was talking. I was just
Hey,
talking to
sorry.
myself. No problem. Okay, so I don't know where you went off, but
When
this is what
you
I was explaining.
when you were explaining the sensitivity.
Yeah, I was explaining the sensitivity too. So I already said that sensitivity will tell you the impact of your forecasting factor on your model. You
Yeah.
understand? So you have a forecasting factor. For instance, this is a forecasting factor. This turnover is a forecasting factor, 5% rather. It's a forecasting factor. So if I look at the effect of this forecasting factor on my
Um,
performance, financial performance metrics, do you
mm,
get? So I'm changing this, I'm looking at the effect, the immediate impact. So that is sensitivity.
okay.
But scenario analysis is now saying you have a case in this situation. Is looking at, you understand? If you look
Yes.
at it in a way, both scenario analysis and sensitivity analysis are similar. Are you getting
Okay.
me? Just that, of course, because you know why they are similar, because both of them are looking at forecasting factors. You are examining forecasting factors and looking at the effects of those forecasting factors on your performance, financial performance metrics. Do you
Okay.
understand? The only difference, that's the similarity. Both of them examine forecasting factors, that is financial forecast factors, and look at the
Yes.
effects of those forecast factors on financial
Uh,
performance
um,
metrics. Do you
matrix.
get?
Okay.
That's the similarity. But the difference between the two is that while sensitivity analysis just look at effects, do you get? Just
Yeah.
look at effects only, like you just want to see the impact of those forecasting factors, how sensitive they are to your model output.
Yeah.
Scenario analysis will look at three basic situations. It's a
Yeah.
situation analysis because
Yeah.
it takes a look
Situation
at the base
analysis.
case, yes, it takes a look at the base case, the worst case, and the best case scenario. So
Yeah.
under those scenarios, so it's like outline, it's like under those scenarios, you will now be seeing the effect, you will now see the effect of each of those forecasting factors as the scenarios dictate. Do you understand?
I
On your
get.
financial performance
I
metrics. So
understand.
exactly. So scenario analysis is like combination of sensitivity analysis, but
Yeah.
under different situation.
Yeah. Under
What
different
sensitivity analysis
conditions, like all those base, best, and
exactly,
but
exactly.
but
It's still
that means
sensitivity.
sensitivity is built into it, into those situations,
Exactly.
those three different
Ex,
situations.
ex, yes, exactly. You are correct. You are correct. Because in one of the literature I read, in one of the sorry, I said in one of the financial modeling texts I read, so they also actually related it to sensitivity analysis. Like looking at scenario analysis is just the same thing with sensitivity analysis, but the difference is that for scenario analysis, you now have situation in place. You understand what I'm saying? You now have best case, worst case, and base case. So that's just the explanation on that. So
Okay.
so let's look at how we carry out sensitivity analysis and scenario analysis. So we are going to build first. We're going to build a caps lock is on here. So I'll just type sensitivity analysis here. Okay. So basically, what we use for sensitivity analysis and scenario analysis is data table. You come to data. Here you will see, you will see what if analysis. So under what if analysis, you see data table, you see scenario manager, you see goal seek. So basically for sensitivity analysis, what we use is our data table.
Okay.
You understand? So we're going to see how we are going to define that. So now for sensitivity analysis, there are two situations you can have. Are you getting me?
Okay.
Now you can have a one-factor input, right? And you can have a two-factor input, one-factor input or two-factor input. So the difference is this: in one-factor input, you should be taking jottings for some of these things. So the difference is this:
before you even said it, that thing just struck me. Immediately, I just opened my book. You just spoke it. You just said it.
You said what?
I said immediately. I just opened my book. That was when you said it.
That means we are in the same spirit now. That's good.
Yeah.
Okay. So there are two types of sensitivity analysis. The two ways you can do it. So I said one is one-factor input and the second is two-factor input. So in one-factor input, as the name suggests, one factor. So you're only looking at just one forecasting factor. I may decide to have my turnover as a forecasting factor that I'm looking at. So I'm now saying that I'm looking at the sensitivity of turnover on maybe gross profit for a particular year, say 2007.
Yeah.
You understand now?
Mm.
So that is one factor. But two factor, I will have to take more than one forecasting factor. So it could be turnover or it could be cost of cost of sales, this 52% here. You understand?
Okay.
So those are two ways you can go about it. So the first thing we are going to look at now is the one forecasting, the one way forecasting factor. So let's take a look at that one. So let's see how. So if you want to do the one way forecasting factor, so what we're going to do is we can pick for a particular year, right? So pick for a particular year, say for you want to see sensitivity analysis for, let's say, 2007. Understand? 2007. Yeah. So you can format this to look pick any color you want. Okay, so for 2007. Now the first thing you now define, of course you have taken the year you want, so you can pick. You can just link this. I always like anything in Excel is always better you link. You understand?
Yeah, definitely.
So yeah, 2007. Now, now the next thing I will now do is I will have to go and get my performance metrics, financial. No, I told you that sensitivity analysis. Please, sensitivity analysis is used to show the effect of your forecasting factor on your performance metrics, financial performance metrics. If anybody asks you what sensitivity analysis is, just say, number one, you have forecasting factors, you have performance metrics, financial performance metrics. What's the effect of those forecasting factors on your performance metrics? That's just what it's talking about. So now you have all your forecasting factors here. You have these as performance metrics, right? Financial metrics. Now what you now do is, so you go and pick all your, you go and select your performance metrics one by one. Of course, you want to select your, you want to pick your gross profits, or let's just start from EBITDA. EBITDA is always better. Okay. Yeah. So you want to pick EBITDA. You want to pick EBT. You want to pick It's just okay, EBIT. So EBT, you want to pick parts.
Parts.
All right. So yeah, your profit after tax. Okay. So this is basically what we have. You can have other performance metrics that you may want to include, but for now, I think that's what our this thing can give us. Let me format this thing properly. Let me just leave it. You can do that one. You understand?
Yeah.
But most important thing is that we understand what we want to achieve. You get now. So
Yeah.
for this one, now the next thing is, of course, we go and pick these values for 2007. So you have your EBITDA. I may not necessarily link all this one. It's not necessary, but these are texts. So let's just have it the way it is here. So now, but this one you have to link, right? So
Yeah, sure.
EBITDA, what's your EBITDA for 2007? Your EBITDA for 2007 is this, right?
Yeah.
Your EBIT, you get
Yeah.
your EBT
EBT.
and your PAT. Okay, so you see now, so this makes sense, right?
Okay.
Now, so you have defined your performance metrics. So what I will do here is, let me do something like this for you. This is now actually, it's just for tutorial. You may not necessarily do this if you are doing the actual, you understand now?
Yeah.
So I just want to do this for you for tutorial. So it's not, it shouldn't be part of your model if you are doing it in practice.
No problem.
Yeah. Okay, so those are your financial performance. So those are your financial performance metrics, all of this. Okay, so the next thing you now do is to come to your forecasting factor. All right. So you have to come and state your forecasting factor here. So for your forecasting factor, you may want to choose. So what do you want us to choose as forecasting factor? Out of all these forecasting factors, anything at all you may want to choose. So let's say we want to choose,
Let's say
for
choose that
instance, we want to choose turnover. Yeah. So let's say we want to choose turnover. Now, so what you will now do for turnover, okay, is this. The reason why we actually call this sensitivity analysis is this, and you must take note of this. It is called sensitivity analysis because under this situation of turnover, you want to see if you have your forecasting factors to be more than, how will I put it now, varies. Like it varies, it's not just 5%. You have it within the range of, let's say, 1% to 10%.
Okay.
Are you getting me? So under these different percentages, what would be the effects on EBITDA, on EBT, on EBIT, and on PAT?
Okay.
Do you understand what I'm saying? But this is
Yeah.
actually a it's a
Just
straightforward
that one.
answer. Exactly. So it's a straightforward answer because we know that, of course, if turnover is increasing, if turnover is improving, all this will improve. Obviously, they will improve. But what we actually want to know is that we are not just, we know they will improve, but to what extent are they going to improve? That is the sensitivity there. I don't know if you get what I'm saying. So
yes.
yeah, so what we'll do is that if this is, let's just say we want to take it from 1%, now we have this to be 2%, right?
Yeah.
So I can take this down up to 10%, right? Makes sense, Abby? So you take this down to 10%. So take it down to 10%. Now, if you're taking it down to 10%, assuming there's another column here, I would have just indicated here that this is, okay, there's a column here actually. So I've just indicated here that this is actually my what?
That's exactly what I wanted to say now.
Sales growth. You understand? Sales growth rate.
Yeah.
Let's do it this way. I'm going to press Alt Enter.
Control
So
enter.
I'll take it to
Alt
the
enter.
next. Yeah, Alt Enter. Yeah.
Yeah.
Exactly. So you see how this goes now. It makes sense, right? So well, let me just reduce this one to, let's say, 10. Get.
Yeah.
It's fine.
It's
No
not
problem.
too small.
All right. So you said
It's not too small. The font size.
the font. I just wanted to.
Make it
I
12.
wanted it
Let's
to
make it
just
12 or just 12.
12. Yeah, 12. Okay. Okay. I didn't want this space to be that much. You understand?
But,
But it's fine.
okay.
So this is the first thing we'll do. All right. So
Yeah.
after this one, so what you will now do is pretty straightforward. It's just to highlight everything. Okay. So you have to highlight everything, right?
Yeah.
Then you come to where you have your data. Then under the data, you have your what if analysis and data table. So in your
Okay.
data table, you have your row input and you have your column input, right? Now all these factors you have specified here is column, right?
Okay.
So your column input, of course, is going to be the forecasting factor you have chosen here. You understand? Because you are using this turnover. Are you getting what I'm saying? So you're actually using this turnover to see the effect of. You are using this turnover to see the effect on the performance metrics. So this turnover is the basis for
metrics.
Exactly. So it's the basis for the calculation. You get now. So if I select this one now, and I come down here, let's just put this one by the side. So if you put this by the side and you press your OK, so you see what happens there. You understand? So that's basically why we call it sensitivity. So it's not really.
Excuse me.
Yeah. Can you hear me?
Did you pick? I don't know. I just looked out immediately. I just like 1 second and you completed that part. But I know. Did you choose one? The column, the rows, the sensitivity rows now, the growth rows.
The what?
Did you choose all this 1%, 2% in that dialog box?
No, I didn't choose all this. I didn't choose. It's only one that I chose. It's only
one.
It's only what I just did here is that
you picked 1%.
Look, this is what I did. I picked 5%. 5% is the forecasting factor for revenue.
Yes, I understand.
You understand? So is this 5% now? I now picked. Are you getting me? Is that 5% I picked? Not 1%.
I know. What we did I'm talking about the row.
The row. No, there's nothing in the row.
Okay.
It's one factor now. It's one factor.
Okay. Yes, you said it's one factor approach.
It's one factor approach. So we're only looking at column. We are not looking at row. Okay. Do you get now? So it's only this factor. It's only one factor, which is sales growth, and which is this. So this is the basis. Yes. So we are saying that, okay, it is 5%. On the basis of 5%, okay, look at this now. Let us validate our sensitivity. Are you listening to me? Should I do this again? Yes. Do you understand it? You understand? You understood all this, Abi? Okay. Yes. So if you look at 5% here, are you getting me now? Now 5% is giving you EBITDA of what? 280.2, Abi?
280.
Yes, now. Sorry, yes. I said 280, 340.
340. Sorry.
340, Abi?
Yeah.
So what do we have? 5%, 340. You can see it's correct. EBITDA. Yeah. You see it's correct, right? True. So that is what we are talking about with sensitivity analysis. So sensitivity analysis will now look at different growth rates. You understand now? So we are now saying that okay, what if the growth rate is now 2%? EBITDA is going to be this, EBIT is going to be this. So that's what you get.
Okay.
Do you get now?
Yes.
So that is it for one factor input. So what we are going to see next now is the two factor input. So let's see how we are going to do two factor input. So for two factor input, as the name suggests, we are going to pick two factors. So we can decide to pick turnover and what? And cost of sales, for instance. I will now see what will be the impact of turnover, are you getting me?
Yeah.
And cost of sales on any of these forecasting, any of these performance metric. Do you understand?
Yes.
So the difference now is that for the two-way forecasting factor now, are you getting me? For the two-way sensitivity analysis,
yes,
you are going to have just one financial performance metric that you are looking at. Do you get? But for the one factor input, you have a series of performance metrics.
Okay. So once you move to two, you only pick
once you move to two, you are looking at
one.
just one performance metric. But that doesn't mean you can't change that performance metric. You don't understand what I'm saying? It doesn't mean you cannot change it. You can always change it. For instance, okay, let's just do it so that you understand what I'm saying. When I say you are looking at one, doesn't mean it is static.
Okay.
It means that at a time, you can only pick one financial performance metric.
I understand you.
Yeah. So let's look at how that one will go. Now, for that one now, it's still the same thing. Let's still look at it for the same year, right?
Okay.
So look at it for the same year. Now, if you want to do two-way now, what is going to mean? Please look, pay attention to this two-way. It's very important, right? So what you are going to do for two-way is it's going to be two forecasting factor, as I've said. Now, the first forecasting factor that we may want to pick can be our turnover, right?
Yeah.
So let's say turnover, we start from 5%, 6%, 7%, 8%, and 9%. You get now? So that's for turnover. Please make sure you leave a space here. I'm going to color this space with yellow. Space before this one, just one. You understand?
Yeah.
Then here, under this yellow column, we're going to have our forecasting factors for cost of sales. This is 52% here. We can vary it. That's why it's sensitivity. It has to vary. Let's say 37% here. Let's say 38%. So we can take this down to 50. Let's just make sure we cover that 52. So let's say 53%. You get now?
Okay.
So everything here represents your cost of sales. You understand?
Yeah.
So let me just use this to indicate that. So that's it. Now, the next thing we'll now do is, so you now look at what you have here. You can have another formatting here, right? Now, this formatting here is where you will now decide the particular metric. Are you getting me? The particular metric you want to work on. You get now?
Work on.
Exactly. Yeah. So you now look at all these performance metrics. These are your performance metrics, right? Gross margin, EBITDA, EBIT, EBT, and PAT.
Yeah.
Okay, so let's say I want to pick EBITDA. So it depends on what you want to work on. Do you get?
Yes.
All right, so I'm picking EBITDA, right? Now what I will now do here is I will now come here to where I have this yellow box and I will type equals to. I'll now go up and look at where my EBITDA is.
To pick the EBITDA. Okay.
Yeah, you can see the EBITDA. So this is the EBITDA for
Yeah.
2007, 340.6,
Yes.
right? And I'll press
Yes.
enter, right? Now what I will
Yeah.
now do now, so hope you follow me up to all these steps. I mean, you understood everything here.
Yes.
Everything I just did. Now what you will now
Yes.
do here now is to now select everything, right?
Yeah.
Select everything here. Can you see?
Yeah.
Select everything that way. Then you come back to your data and go to what if analysis, right? Then
Yes.
click on data table. Okay. Now scroll up, right? Now your row input. What's your row input cell? Of course, your row input cell is this is it, Abby, which is the growth per year. Now the growth per year for 2007
I
is
didn't get
what?
that.
Let me go back. This is your table, right? I said the first
Yes.
thing is this is two-factor input.
Yeah, I
The
got
first
to
one we
that.
did is so we are going to make use of row and column. For one factor input, is only column you are making use of.
Okay.
But for two-factor input, you make use of both the row and the column. That's why it is
Column.
two-factor input. You understand?
Yes.
Now, what is the row here? The row is growth, sales growth, Abi, per year.
Yes.
So you go up and come and pick it for 2007, please, because you are working with 2007 EBITDA.
And so,
So
yes.
you come and pick this now, 5%. Do you understand?
Yes.
For row. So you pick 5% for row. Now come back. The column is what? Cost of sales to sales.
Also,
Abi?
so
Then you pick this, that's a column, right? Then you select this. You get now.
okay.
So let us see how it's going to change. Okay. So you see what you have there. So that's all. You don't want to show it here, right?
Okay.
So you have to hide this. And how do you hide it? All right. So when you click on format, then here you type OK. It will hide it. Do you get? So you can remove that yellow. You don't need it. It's just for tutorial. That's why I'm putting it. So remove the yellow. So this is what you have for two-factor input sensitivity analysis.
Can
This
you
is
quickly do that?
one-factor input.
Undo that. Can you quickly undo that hiding? Undo and redo the hiding.
Okay. Okay. So what I did is I right click, then went to format cells,
Format cell.
remove everything here. Remove everything here and
Okay.
type semicolon.
Okay.
Then OK. So it takes it
Okay.
out.
Okay.
That's what I did.
Okay.
So this one is, so let's test this thing now. Look at, it is 5% here, right?
Yes.
And it is 52% here. What is the EBITDA?
Is correct. 340.
It's correct, 340. You can see it's the same thing we got here.
Yes.
Can you see it?
Yeah.
Aha. And can you see it here as well?
It's there.
It's there. So which means what we are doing makes sense.
Okay.
Exactly. So this one will now look at both intersection of, so you
Row
can
and
pick
column.
for anyone. Exactly. So you can pick for anyone. I mean, decide I want to do it for 2008 or any other date.
Yeah.
What I would do is just to change the nomenclature and everything changes back.
Okay.
Yeah.
So does it mean
So
that one can actually do this for each of the years?
yeah, you can do it for each of the years. You can have another one here and do another
Yeah,
one here.
and do another one.
You can,
Okay.
yeah, and do another one. So it's just going to be like a complete. It's not going to be like all these are mathematical tables that we use.
I
But
understand.
yeah, the essence is just that management can see the impact of different sensitivities, different situation at a glance.
Okay.
So that's it.
No
All
problem.
right. So
So
now,
if
so what?
if hello.
Yeah, I can hear you.
So with this now, if since we are doing all this, the performance metrics we've been using are all income statement performance indicators. What about the balance sheet?
Balance sheet.
Is there
You can use balance sheet now.
can we
You can
also
do it
do the
for
same
any.
thing?
Yeah, you can do it for balance sheet as well.
Okay, we can
If
also
you
do
have
it for
performance metrics here, maybe you have performance. Anywhere there is a formula, it will work. Anywhere you have a formula and a forecasting factor, it will work. Do you get? Like here now, of course, we can't do it for PPE. It's not a
okay.
performance metric. Just look for where you have
Yeah.
performance. Do you have any performance metric here? Not really.
Yes. Okay.
Which one?
Okay.
In the
Like all
balance sheet?
the summation areas, summation areas.
No, we can't be doing it for all this. We can't be doing
Like
sensitivity analysis for
all these
total
places
assets.
that
So
we sum like all these places that we sum the things up. Like
which
maybe
places?
the total non-current.
Sensitivity analysis for total non-current
Okay.
assets? No, we can't be doing. It has to be something like performance metrics, like
Okay.
financial performance metric. We can't be doing sensitivity analysis for total non-current asset now. What do you want to achieve there? You understand what I'm saying?
You
It's only
said there
maybe
must be
maybe
formulas.
yeah, there must be formula and it must be a performance metric, financial performance metric.
Okay. Like working
It's not
capital
just
now.
yeah, working capital, yes, you can do it for working capital. Okay, you can do it for working capital. Okay, so let's say we want to do it for working capital now, and we want to pick so what forecasting factor can we pick now? Let's say we want to pick payable. So you want to pick this one, 6.1%. I want to look
Okay.
at it here. So this and this, Abby,
Yes.
that fine?
Yeah.
Okay.
Okay.
So
The
this,
effect of
that, and that
payable on working
on the working
capital.
capital, the sensitivity of payable on the working capital. So
Okay.
what we just now do is still the same thing we did. If it is of course, it can be, it should be a
The
one
two
forecasting
still.
factor, right? So you may not just want to pick payable alone. You may want to pick deferred income tax, other current liabilities as well. So you pick
Yeah.
all of these three. Are you getting me? So all of those three will be here. Do you understand? Then
Yeah.
your forecasting factor, which is this 6.1%,
Yeah.
are you getting me?
The column.
6.1% will be the column.
I get.
Be the column. So that's just it. It's just for you to define what your performance metric is and what your forecasting factor
No
is.
problem.
So if you are taking this one, but in this situation now, the only performance metric is working capital. So it's just going to be working capital alone.
Yeah.
You don't get it now. We can't pick
I
deferred
get.
income tax and other current liabilities, but those are forecasting factors. So it's just going to be only this one with this one, but you will now vary this one. Maybe you can say this one between 1% to 10%.
Okay.
So when you now
That
vary this forecasting factor, yes, so when you now vary this forecasting factor, you can be seeing the different effects on your working capital.
okay.
That is how sensitive. So you now say, if management now say how sensitive is your account payable to working capital,
Working capital.
that's what you can do now.
So it's same
Between the
thing.
range of 1 to 10%, how sensitive is your account payable to working capital? In the range of 1 to 10%, you can just
or inventory to working capital, or
or
account
inventory to
receivable to working capital.
exactly. Whichever situation you have, just work it out either as one factor input or as two factor input.
Okay.
It's going to be correct so long there's a formula there and you have
Okay.
defined it correctly. Like here now, you pick all these ones from the income statement. You understand now?
Yes.
Here, you pick them from income. Here, you don't pick anything from any income
Yes.
statement. Do you get? Here,
Okay.
whatever the formula that is here is picked from the income statement.
Yes.
Here, you don't pick anything from income. Here, you don't pick anything from income statement. So it is this
Okay.
formula now that Excel will now apply to calculate everything here.
Okay.
It is a
Okay.
formula in that income statement that we built here,
That will build.
that Excel
that
applied
will
to calculate all of this. So it's not
Okay.
like Excel is now calculating, doing the income statement sensitivity one by one, doing all this calculation one by one, and arriving at all this series of numbers.
Yeah, because we have already chosen the EBITDA, the EBIT and everything from the income statement, and it's working with
Exactly.
the formula involved.
And it's working with the formula. Yes, exactly. You understand now? Okay. Can we go to
Yes, we
scenario
can.
analysis now?
Yeah.
Okay, so that's it. Now here, data, right?
Yeah.
Group. So you see how this looks like now?
Yes.
Get? Yeah. So it's fine. Oh, there's okay. I want to drag this one down. Just leave it. Okay. So let's see our scenario analysis. So all these ones are just add-on. The major thing is your financial statement. So these add-ons will now be explaining what is in some other instances you may have financial analysis as well. Then we have business valuation. You understand? So which we are going to talk about. Yeah. So which I say you should try and work on your own. Just try and build that one. I will now revise it together. We watch that video. It's very simple. Yeah.
Okay.
But there are some things you are going to assume. There are some things you may want to assume. All right. So business scenario. Analysis. Okay, so scenario analysis is another one interesting thing in Excel that you can use. Okay, as I've said earlier, it is the same thing with sensitivity analysis, except for the fact that scenario analysis is sensitivity analysis that looks at different situation. Under different situation, what will be the effects of those situations on the business? You understand now?
Sure.
Okay. Now, so let's see how we go about this one. So for scenario analysis, so basically what you are going to do is you're going to first of all build your table. Right? So you have scenario analysis. Now, I told you that under scenario analysis, okay, what you will have is you will have your current value or your base case. Okay? They call it base case, or let's just call it current value. Anyone you want to call it. I prefer to call it current value.
Okay.
You understand? Then next one, okay, is going to be optimistic. So what the current is the same thing as the base.
Yeah.
Forget.
Yeah.
So this is the first thing you have to do. First of all, design the table. It's very important that you design the table, right? So let's format it. What am I doing? Okay, let me just pick that white. So I'm going to pick this one eventually. Okay, so now this is the first thing. Now the second thing is you come here under this, right? You may decide to have double strike, one up, one down, right? Something like this. Now here, you will have your, you can type in your changing cells there. I will tell you what that means. Okay, so you have your changing cells there. Then, so now this changing cells, what do you mean by these changing cells? So those changing cells are actually your the forecasting factors, those line items that makes up the forecasting factors. Are you getting me? The
Okay.
line items that makes up the forecasting factors will be your changing cells, because those are the cells you are going to be changing. Those are the,
Yes.
let me open it for you. If I open the financial
Things
statements now.
things like turnover,
Yes, like turnover, like
cost of
cost of
sale,
sales, yeah. So
depreciation, okay.
depreciation, exactly. So they are those, they are the changing cells, right? So
Okay.
so sorry. So what we're going to do now is we're going to look at all those changing cells based on what we have on the forecasting factor. So we can decide to pick turnover first, which is revenue growth.
Yeah.
Right? It's a
Yeah.
forecasting factor now.
Mm-hmm.
It's in percentage now.
Yes.
Another thing we want to also look at is we want to look at the cost of goods sold.
Yes.
Cost of goods sold is a percentage of revenue, right?
Mm.
So we may also look at depreciation and amortization, right? We want to look at depreciation and amortization. What else can we look at? We want to look at the net interest expense. We will forecast this one too now, Abi.
Yes.
Okay, so that's fine. So we have defined all our changing cells.
Just include the selling, general and administration, so that we will know that
Yeah.
we picked
Okay.
almost
Yeah.
all the
Yeah. Yeah.
stuff.
Yeah. Yeah. Okay. So now, so the next thing is for us to now say, first of all, you have all your forecasting factors. Those forecasting factors, those line items that make up the forecasting factors are your changing cells. Then the next one you will now do, the next thing you will now do is to get your what? Is to get your financial metrics. You get now? Financial metrics. So it
Okay.
now depends on the year you want it. Okay, so we may want to choose 2017 again, the scenario for 2017. So this is the scenario for 2017. So I have 2017 here. And what are those performance metrics that we want to pick? We want to pick EBITDA, we want to pick EBIT, we want to pick EBT, and we want to pick our PAT, or net earnings. Yeah. So all right, so that is it. So this is the first thing you have to define. So once you define this one, it's the first thing you do. This is the first thing you do. So after you now do this, the next thing is now for you to now go and do your calculation. So it's quite some steps you need to observe. So first thing is prepare the table the way it is like this. The next is to now come to, it's still data you come to, okay? Come to where you
Okay.
have your data. Then under that, you still go to what if analysis. You understand? So under what if analysis, you now pick scenario manager.
Okay.
You understand? So you pick scenario manager. Now, this is how your scenario manager looks like. So your scenario manager, so the first thing you have to do, take note that we are dealing with what? 2007, Abi? So the first thing you have to do is to come and add. So you create the scenario. The scenario name is, the first is what? Optimistic.
No. Current.
No, the thing is that,
Value is the first.
wait, this is it. If I pick optimistic, are you listening to me? What I'm going to pick is optimistic. Now, as I'm picking optimistic, what I'm going to pick in my changes cell will be the current. Excel will automatically return the current for you. So you don't type current.
Okay.
Do you understand?
Okay. Yes.
Are you there?
Yes.
Hello?
I'm with you.
Can you hear me?
Hello, can you hear me?
Hello?
Hello? I can hear you.
Can you hear me?
I can hear you. I can hear you. I can hear you. Hello?
Can you hear me?
I can hear you now.
Can you hear me? Actually, wait, this is it. Optimistic. What I'm going to pick. Can you hear me? Can you hear me? Yeah, can you hear me? Hello? Can you hear me?
Yeah, I can. Can you hear me
Okay,
now?
so let me go back. Yes, I can hear you. So what I said before you went off is, you will not type current in any scenario name. Do you
Okay.
understand? Excel will automatically pick current for you. See, it is that
Okay.
current that Excel will now use to get to, anything in Excel is that Excel must have a base for calculation. Do you understand?
Okay.
It is the
Yes.
current that Excel will use to calculate optimistic and pessimistic situation for you. So by
Okay.
default, Excel is going to return your current scenario because your current is already calculated. So Excel doesn't need to calculate your current. So you don't have to choose current because your current is given.
Okay.
Do you understand? But your optimistic and pessimistic case is not given.
Yes.
Do you understand? So if I'm putting current here, it's like I'm going to repeat what has been done already. Current is what I'm looking at.
Okay.
So Excel is just going to, you are just going to pick those values and Excel will return what you have picked because it's current.
No problem.
Do you understand? But on the basis of that current, Excel is now going to tell you what is optimistic and what is pessimistic based on the changing cells you have defined in your scenario. Do you understand?
Yeah.
Yeah. So I've entered optimistic here. Now, the next is now to come up to my changing cells. So my changing cells, if I come down.
Will it not, sorry.
Yeah, I'm listening.
Will it not have effect if you leave it at optimistic and you're supposed to pick and we used optimistic case? Will it not have issues? since you typed optimistic, and on the worksheet itself, it is an optimistic case. So the non-completion of that particular case will it not be a problem?
The non-completion of which case? I didn't get your question.
Since on the scenario analysis sheet, we are supposed to have what we typed there was optimistic case, but in the scenario dialog box you wrote optimistic. Will it not have issues? Since that
No, it won't have issues. No, it won't. It won't have issues. It won't have issues.
Okay.
At the end of the day, what Excel is going to give us, Excel is going to return a table for us. It's on that table, it's in the basis of that table that will now populate this one that we have here.
Okay.
Let's just continue. We'll see what I'm talking about. But if you have questions, you can always ask. Yeah. So the changing cells now. So when you scroll down, so this changing cell, number one is what? Revenue, Abby? Yeah. Revenue growth for 2007. So you go and pick revenue growth. Take this one out. So you pick this one, right?
Yeah.
Yeah. So the next one is, of course, command. You look at another one. Cost of sales. Cost of sales, you pick this, right?
Yeah.
D&A as percentage of PPE. You pick this. Net interest expense. You pick this. What's the final one? SGA. You pick this. You understand? So that's the first step. Are you getting me? So you now click OK. It takes you here. Are you getting me? Now this is where you will now tell Excel what the optimistic case is. You understand what I'm saying? Because what you have, the first thing you selected, no, that's what I told you. That first selection we made is base case.
Yes.
This thing, the first selection, we have passed it. That first selection that we have just passed is base case. So now is when we want to define optimistic. Yes.
Oh, so yeah, now I get.
You understand now? So now we want to say what is the optimistic case for revenue? We had it to be 5%. So optimistic case will just definitely be an improvement of say 7%, 0.07. Yes. So we had our cost of sales to be 52%. Our optimistic case will reduce
48.
We reduce it, Abby. Let's say 40.
Okay.
You understand what I'm saying? Optimistic for cost of sales is going to reduce now.
Yeah, I get. That was why I was even thinking 48, but 40 is okay.
Yeah, 40 is okay. We are just assuming. You get. So, but when you are optimistic, when you are being optimistic, you look at different economic situation, blah blah blah. Say, okay, we are optimistic that our cost of sales to sales should reduce. You understand? Based on maybe improvement in production methods, sourcing of raw materials. There are some things you take into consideration. Then you understand now?
Sure.
Then what of D&A? You may want to say, of course, improvement will be that it will reduce. Because it's an expense. So improvement can be 5%, which is optimistic.
Yeah.
Net interest is an expense. Improvement can also be, let's say 4%, right?
Yeah.
SGA is an expense. Improvement will be, let's say 20%.
20.
Yeah. Then you click on OK. So it takes you here. Do you understand? It takes you here again. Now, the next thing you will now do is to now click on summary.
Okay.
Are you getting me? You click on summary. So now the summary is where you now go and select your financial performance metrics.
Okay.
Are you getting me? So those financial performance metrics are your EBITDA, EBIT, EBT, and PAT. So you go to your income statement. and select, this is EBITDA, right?
EBITDA. Yes.
EBITDA. What again?
EBIT.
EBIT. So I want to pick EBIT first. Yeah, EBITDA, right?
Yeah. EBIT next.
EBIT.
Then EBT.
EBT.
PAT.
Okay. So finally, we click on OK. Oh, there's something we needed to have done before clicking on that OK. You understand?
Okay.
Before clicking on that summary, are you getting me? Before going to that summary, we needed to have defined our pessimistic case first. So I will go back and redo it. Do you understand?
Yeah.
Otherwise, it will just return only optimistic case. So
I
I'll go
wanted
back and
ask
redo that. Okay, you wanted to ask.
I wanted to ask, but I felt maybe that's the way.
No, that's not the way. You should have. Assuming you asked, I would have just stopped there. Okay, no problem. So let's just quickly do that. So I'm just going to be faster. Sure, you get now.
Yes.
I'm going to be faster. So we have already defined optimistic case. So we are not starting again.
So,
so what we are not going to do, you know how we got here now? It's just God bless you. So we just add. Do you get? So this one will now be what? Pessimistic.
Pessimistic.
Exactly. So you now still click on. Now, if you select this pessimistic, it will pick the original this thing that you picked before. You can see L8. What is L8? L8 is what?
L8 is turnover.
Turnover, which is the base case.
Yes.
You can see. So by the time you now, of course, which is 5%. So by the time you now click on OK, it will take you here, where you will now define what is pessimistic.
Pessimistic.
Exactly. So pessimistic for turnover.
I said 3%.
We know what we pick now. Pessimistic for turnover, of course, is going to improve. Let's say 7%, right?
Pessimistic should reduce.
Sorry, pessimistic should reduce.
3%.
Yeah, 3%. Then cost of sales
increase to 59.
Increase. What can we put it? Let's say 60, Abby.
Yeah, okay.
It will increase now.
Yes.
60. Which one again now?
That's I think D and A.
L15. D and A. So L15, D and A are pessimistic. It will increase, Abby. Let's say 10.
Increase 10, yeah.
Yeah. L17 is net interest expense. Pessimistic. What can we put it at?
10. Also, okay, let's say 9.
Let's say 9. Last one. L13. L13. Okay, let's say 33.
SG&A. 33.
SG&A. 33. Okay, now click on OK. 33 now. I tried 33 there. Can you hear me? Hello? Are you there?
Yeah, I am.
Yeah, it's fine. I typed 33 there. It's pessimistic now. It went up.
Okay. Yeah, I don't know. Yeah. I understand.
So what we just do now is we now come to our summary now. Okay. So for the summary, we have selected it already.
Yes.
We don't need to select again, Abby. So let's now click on OK. So it will run it. So it's going to take some time. That was why the other one was faster because it was just so this is the scenario summary.
Okay.
Okay. But as this one is now, you can't present something like this. So that's why we had to format a table already. Sorry, where's our FS1? So that's why we had to format something like this. You get now?
Yes.
So what we now do is to link this to the scenario summary.
Okay.
And come and pick the current value.
Okay.
You get now? Then take this down and like this. Exactly. Then you come and pick this one as well. Take it down and then like this. So that's just what you do.
Okay.
Yeah. That's us. So at the end, you will now come and hide this one. You get now. So this is it. That's all. So you can see this makes sense. Let's look at it. We have the current value as this. So you can look at the current value of, so you see what I'm telling you. The current value of revenue growth as percentage of sales is 5% here. And EBITDA is 340. Is that not what we have?
That's what we have.
Exactly. So if you now look at, so it went up from 5% optimistic to 7%. So if it is optimistic at 7%, EBITDA will now be 767. Instead of calculating everything, all the income statement again to now see what EBITDA is, this table will just tell us what it is, what it will be. You get? If you are pessimistic at 3%, it should go down.
Yes.
Of course, EBITDA will go down because we are pessimistic about revenue growth.
Yes.
So you can see that all these things now are still sensitivity.
Okay. Okay.
This is still sensitivity, but it is now scenario analysis because it is current, optimistic, and pessimistic. But each one of them, like individually, like this, individually is a sensitivity analysis. That's the truth.
That's what it is.
If you take just this,
that's what it is.
Yeah, that's what it is. That's what it is. But it's now looking at scenario, situation.
Okay.
So you see that when we had a worst case year of SGA to 33%, our net earnings, profit after tax, was negative 34.7. That was a loss.
Yeah.
Because SGA is just too high.
Yes.
Here. You can't afford to have SGA
that high.
The worst case of 33% to be 123 of our EBT. So that is it. So we're going to end it here.
Okay.
So this one as well, group it. Always. So you can see what we now have. So this is just what you have. So with this now, so what you can see here now is from a simple trial balance, 1, 2, 3, just simple trial balance. You see now, we're able to build financial statements for historical period. Are you getting me? And we're able to forecast. We are able to forecast them. You can see what we did, and it's balanced. Everything is correct. Then after that, we went further to do sensitivity and scenario analysis. So this place is actually just sensitivity analysis. This sensitivity analysis here, we look at one factor input and we look at two factor input. Then later we finally went to scenario analysis, where we look at different scenarios. So the next thing we'll now look at is business valuation. Another add-on we here, where we'll now do, but not today. You have to do that. Try and attempt this one. Attempt this one. Pause that video, attempt it. Yeah. So that's your own assignment. Yeah, so that's what we are going to end.
But we are still going to do it now.
Of course, we're going to, why not? It's a complete, so with this one now, with this one, so this is actually how we do a complete financial, with this one, with everything here, this financial model is complete. In fact, it's not even going to end here. Before this one, before this one, somewhere here, you may want to have you get this is complete now.
Okay.
You understand? So you have your financial statement, your sensitivity analysis, scenario analysis, financial indicators, and business valuation. So
Okay.
you now see a situation where at any point in time where you are changing any of these forecasting factors, the value of the business will be changing,
Okay.
financial indicators will be changing. You are defining
Okay.
scenarios are changing, sensitivities are changing based on what you have defined. Do you
Okay.
get now? So this is
Again.
what we now mean by advanced. Yes, advanced. This is advanced financial modeling. You must have all this.
Okay.
So by the time you now finish from here, you want to look at more advanced situation where you have merger and acquisition, leverage buyout. That one is going to more of investment banking, equity, whatever. So this is majorly where they will look at, because when you want to merge a business, you have to value the business.
Yes.
There are some things you have to determine. So this way we now start looking at stuff like free cash flow, uh, growth rate, weighted average cost of capital. You understand?
Okay.
Exit EBITDA, stuff like that, multiples and the rest. You
Okay.
get now? Yeah.
I
So
get.
for budgeting, when we also do budgeting, when we get to budgeting and variance analysis, we'll be applying sensitivity and scenario to now say, okay, you are doing annual budget for this time. It's very simple now. When you do
I
your annual
get.
budget, you want to do sensitivity analysis. Like what we are budgeting, what will be
What if we
because
don't?
in budgeting as well, you've made use of forecast.
Yes.
You understand? So you may want to be changing your forecasting factor and be seeing the impact on your budgeted income statement and balance sheet. You understand?
Wow.
So
Yeah. Exactly.
no problem. So I'll end it here.
So
Let's end it
that
here.
this same scenario is what these people at FMI use choose and using of combo box to build this is. It's not that their presentation is different from this. This is another way of presenting, collapsing everything into a smaller space. But theirs
Yes, yes.
is always big.
No, I always like my model to be simple. As I've said, modeling is different people have different way of doing. Don't be surprised if you use
Sure,
this
sure.
method, you will pass. You will pass even excellently. Because you might even be teaching the person that is you might observe at the end of the day, you have taught the person that is even marking your script what he doesn't know.
The new things that yes.
That's it. Because what most people will do for you said?
I understand.
So because what most people will do for this scenario analysis, they may want to use that option of choose. In that option of choose, they are not even making use of data table. They are just making use of straight up formula. You understand?
Yes.
So it's good you know different method, but for me, I rather prefer I use the data table. But this is what Excel really, this what if analysis.
Advice. Okay.
You understand? It's what Excel really recommends. What is inbuilt formula in Excel. So you don't have to be using all those choose.
Okay.
You understand? Selecting.
Okay.
For instance, now I want to do scenario for any year here. It's very simple for me to do. I can extend this one and do another one here. So I don't have to be saying choose. I don't have to be saying I want to go and choose optimistic case. I want to go and super. I'm seeing everything at a glance.
Yeah, because even
If I want to do
in theirs, they can just like you did. They only work for 1 year. The years will now be on the row, sort of more like columnar, 2017, 18, 19, 20, like that. But on the left side, which is the row, they will now
for your opinion, which one is better?
changing cells, each one of these changing cells will be the one on the left side with different values under the base case, worst case, and everything, all like that. But they will not have
My brother,
one
use
that
this.
will always change.
I know that method. I know that method you are talking about. It's a long
No, I
method.
understand.
This
I
is
said
shorter.
this one is shorter.
This is better and shorter. I know that method you are talking about. Because one of my friends who is also doing modeling. The guy came and was showing me. I said, well, which one is all this one? And I showed him this method. He said, wow, this is faster and better.
Exactly.
Because and that one you are talking about, they will have the financial statement like this. I know what you are. So they will now be doing the scenario one by one. For Abi, is that what you are talking about? There is a place where they will have something like
Yes,
choose
scenario
here.
one by one.
One by
Yes.
one. No, this one is using data table is better because you can see everything. Because the funny thing is that it's not as if they are even showing it for different years. It's still for the same 1 year, Abi.
Yes.
And now, so this one is better. So if you are writing the exam, you can choose to use this method. No, as I've
Okay,
said,
no
nobody's going to penalize you.
Yes, exactly. The
No,
most important thing is
nobody's going.
the most important thing is making sure that everything is dynamic.
Yes, make sure that everything is dynamic, is linked, and make sure
Yeah.
that what you are doing makes sense.
Yes,
Because this one actually makes sense because you can interpret it.
it does. It does. It does.
And at any point in time, if I want to change anything here, I can come to my data, what if analysis, data table, and just, so I said data table, what if analysis and scenario manager.
Scenario manager.
So from this scenario manager, I can do whatever I want to do.
Yeah,
Do you
exactly.
get? I can go and do anything I want to do. So that's it. So let's just, so please do this business valuation.
Okay. Okay.
Submit it, send it to me during the week. So
Okay.
hopefully by next week. I don't want to promise something. I don't want to say something that I may not do. Because if I have the time during the week, I may drop the video on budgeting. But that's what we want to look at now.
Okay.
So
Okay.
we want to look at budgeting, how we can apply sensitivity analysis to budgeting. So build budget from start to finish.
Okay. Okay.
Understand?
That's good.
How we can apply sensitivity and scenario analysis to budgeting. So at the end of the day, you can see, you can actually, what you can actually be doing at the end of the day is you can actually build a company's budget from start to finish. You can build, so with this one now, you can build integrated financial statement, right?
Yes.
You can
Definitely.
forecast financial statement now. You can forecast financial statement
Sure.
now.
Sure. Sure.
You can do scenario analysis and sensitivity analysis. You know what is two-factor input and one-factor input.
Sure.
You know the difference between the two and how to do it in Excel. And you know the difference between sensitivity and scenario analysis.
Yes, exactly.
Right? So what you need to know now is business valuation and budgeting. Then before we now go to, maybe we may talk about other aspects. So those other aspects like leverage buyouts is just going to be introductory.
Okay.
Those ones will be introductory. We will not really go to it. But the ones you really need is this financial modeling, forecasting analysis, and budgeting variance analysis.
No problem.
So with that, you can actually work fine. Yeah.
Yeah. Thank you.
All right. So later now.
Yeah. No. Thank you. Good night.
Yeah. Good night.